Hi, I'm Jamie Alden, and I'm so excited to announce our new video series for Realtors with my good friend, Chris Bird. Chris used to work for the IRS for over 15 years and is now a sought-after speaker who speaks about tax strategies for Realtors. And I'm very excited to have Chris here join us.
Thank you, Jamie. Hi, my name is Chris Bird, and I'm doing a series of seminars for my good friend Jamie Alden Fay. And my background is this. I'm an ex-IRS agent for 16 and a half years. I'm a certified financial planner, enrolled to practice before the IRS, and most important, I travel the country doing seminars for real estate, insurance, CPAs, and attorneys on tax law and tax strategies. So in this first seminar or webinar, what I want to do is I want to tell you about the potential upcoming changes due to the elections in November of 2024. And we're not going to get political, but we have a previous administration that created a major tax bill called the Tax Cut and Jobs Act of 2017. And watch my arms, all right? It is good for 8 years, 2018 through 2025. So this law goes away on December 31st of 25, and 2026 is going to be a new arena in terms of tax rates, deductions, things like that. So my purpose in this first of our series is to kind of give you a warning about what's to come. And I have them enumerated on the whiteboard in back of me. So first of all, here is the 8-year period, 2018 through 2025. And that's the first bullet. And then the rest of the bullets. Capital gains is a big topic, and realtors, let me tell you this, I am a huge fan of owning investment real estate. My wife and I own a lot of it. And when we sell it, we want to enjoy capital gains, which in general cut your tax rates by more than 50% over if you earn that same kind of profit as ordinary income like wages or real estate commissions, things like this. And suffice it to say, whether you believe this or not, our capital gain rates have been low for a period of years. And there's a lot of discussion to raise taxes in Washington to raise those capital gain rates. So my thought is this: talk to your accountants. In fact, talk to your accountant about anything that you learn from me in this series of webinars before you do anything. But if you're contemplating selling a rental property or a large block of stocks or something like that, then maybe 24 and 25 are the years to sell instead of waiting to 2026 and potentially be faced with higher capital gain rates. Now next, for the last 8 years, we have not been able to itemize our deductions on our tax return. What that means, that's the personal side of your tax return. Charitable contributions, home mortgage interest, real estate taxes, things like that. The Tax Cut and Jobs Act of 17, effective for this 8-year period, took those deductions away for 92% of the population of this country. Well, that means that a lot of us have not been able to itemize. In fact, my wife and I have not been able to itemize for this entire period so far. Well, with the expiration of the Tax Cut and Jobs Act in starting 2026, it's possible, if they leave this law the way it is, all right, that they don't extend it, that we will be able to itemize our deductions again. So there's not a lot of planning there other than talking to your accountants in 2025 after the elections, get a sense for what might change here and what may not change, and maybe you'll decide to prepay some of your charitable contributions in 2025 if this law is not going to be extended, things like that. Next, lowering of the standard deduction. So for this 8-year period of time, a lot of people that couldn't itemize their deductions enjoyed a double standard deduction. So for example, a married couple went from roughly $13,000 or $14,000 to basically over $28,000. Singles, about half of that. Well, if this law is allowed to expire, then the standard deduction will be cut in half in 2026 because that's the end of that doubling of the standard deduction. elimination of the SALT limitation. Now, all of you listening, and I don't care what state you're living in, if you are a member of a pass-through entity like an LLC, a partnership, or an S corporation, talk to your accountant about whether or not you're taking advantage of the pass-through entity tax loophole, which is a way around the SALT limitation. SALT stands for state and local taxes. So Illinois is a high income tax state. It's a high property tax state. It's the way it is, right? So is New York, so is New Jersey, California, etc. So people that live in these high tax states are limited on their federal itemized deduction to a SALT deduction of only $10,000. And let me just give an example. So my wife's and my real estate taxes and our principal residence are $15,000. Our state income tax is another $15,000. Well, that's 30 grand, and we're only able to deduct $10,000 of it. Now that ends at the end of 25, and in 2026, if they allow this 8-year law to expire, then we're going to be able to enjoy larger itemized deductions again, and that's not a bad thing. Well, there's much more to it than just that, everyone. I was just reviewing the other day the previous administration's proposed tax law changes. If he gets in, and the current administration's tax law changes if he stays in. And that's all I'm going to say about politics, but we live in interesting times. Thank you, and I'll see you in the next webinar.